Imagine a company that, on paper is just the ultimate investment.
Right, like the kind of stock everyone wants in their portfolio.
Exactly. You look at their published reports and you see record-breaking cash flow, perfect profitability, and flawless sign-offs from prestigious auditors.
Everything looks perfectly tied out.
Yeah, their income perfectly matches the cash entering their bank accounts. It looks, well, impenetrable.
Totally bulletproof.
But hidden in plain sight, buried beneath a wall of aggregated data, and hinged on a single swapped word in an obscure guidance document, that same company is actually masking a severe structural flaw.
Oh, yeah, it's the ultimate illusion in corporate reporting.
They aren't technically lying about the numbers, but they've engineered the presentation so effectively that the economic reality of the business is entirely obscured.
Right, because we assume that a financial statement is this unshakable mathematical reality. We think of accounting as a binary science. 2 + 2 is 4. But the architecture holding those numbers together is built on frameworks, statutory interpretations, and, well, human judgment.
And humans are flawed.
Exactly. And the moment judgment and language intersect, you open the door to a landscape where you can manipulate reality without ever falsifying a single digit.
That intersection of language, interpretation, and financial reality is exactly what we are dissecting for you today. Welcome to the Deep Dive.
Glad to be here.
Today, we're basically playing financial detectives. We are going to explore the mechanics of how this illusion happens.
We'll look at how tiny details, down to the use of a specific grammatical preposition.
Yeah, a single word.
Right. Or the decision to group two completely dissimilar line items together on a balance sheet. How that can fundamentally alter an investor's understanding of a company's liquidity.
We are moving past the bottom line profit and digging into the structural integrity of the reports themselves.
And to do this, we are utilizing a really brilliant piece of forensic analysis. Our source material today is the 230th edition of the GAAP Advisor's Task Weekly newsletter.
Authored by CA Manish C. Iyer.
Yes, a highly respected authority who has authored, I think, 16 books on the application of Ind AS, which are the Indian accounting standards.
Wow, 16 books.
Yeah, he knows his stuff. And what makes his work so vital is that it bridges the gap between theoretical rulemaking and actual corporate behavior.
He pulls observations from published financial statements and exposes how the standards are being applied or misapplied in the real world. But before we dive into the mechanics of these specific cases, I do need to read a mandatory verbatim disclaimer from our source material regarding the author's work and the scope of the newsletter we are covering today.
Right, the legal housekeeping.
Exactly. So here we go. The views expressed herein are the personal views of the author, CA Manish C. Iyer, Director, GAAP Advisors, and are not binding on the reader. The reader is requested to seek the help of an expert before taking any action or refraining from any action based on the views expressed herein. This edition of newsletter has the following sections: classification of trade receivables and trade payables observation relating to Ind AS 1, presentation of financial statements, Ind AS 7, statement of cash flows, and Ind AS 109, financial instruments.
Okay, so that first section regarding the classification of trade receivables and payables, that sets the stage perfectly for our discussion.
It sounds incredibly mundane at first glance, honestly.
No, it really does. Anyone who operates in finance understands the basic definitions of current assets and current liabilities.
Right, stuff you're going to convert to cash or pay off within a year.
Well, see, that's exactly where the newsletter reveals a massive conceptual vulnerability in how the industry measures time.
Wait, how so?
Because it exposes how standard setters attempt to codify the life cycle of a business into a set of rigid rules.
Okay, let's start right there with this fundamental conflict between a calendar year and the corporate operating cycle.
Yeah, let's break it down.
So the newsletter addresses a specific query surrounding Ind AS 1, paragraph 68, which dictates the classification of current assets, and paragraph 70, which covers current liabilities.
Right.
The core of the confusion rests on how we define the quote-unquote operating cycle. The standard defines it as the exact time between the acquisition of assets for processing and their realization in cash or cash equivalents.
And if you cannot clearly identify that cycle, you just default to 12 months.
So the friction here comes from our inherent bias toward the solar calendar, right?
Exactly. The entire financial ecosystem,
Right.
Tax authorities, quarterly earnings calls, annual general meetings, it's all anchored to a 12-month rhythm.
Which makes sense. It's how we experience time.
Sure, the 12-month financial year is essentially a relic of agricultural cycles. You plant, you harvest, you sell, you calculate the profit.
Right.
But modern commerce does not always fit that rhythm.
I mean, not at all.
No. If you look at the mechanics of a complex manufacturing entity, say a defense contractor building submarines,
Oh, that's a good example.
their cash-to-cash cycle might take 4 to 5 years. They purchase specialized steel in year 1, integrate systems in year 3, deliver the vessel in year 4, and receive final payment in year 5.
Which introduces the primary tension the newsletter tackles.
Right.
Because the rule explicitly states that current assets, like the inventory being built or the trade receivables owed by the customer, and current liabilities, like the money owed to the steel suppliers, they are classified as current if they are part of that normal operating cycle.
Even if they are expected to be realized or settled more than 12 months after the reporting period.
And this is where I have to push back a little.
Oh, go for it.
Wait, if I look at a 12-month calendar,
Yeah.
anything beyond December 31st is next year. It's non-current in my brain.
Naturally.
Let's say we're looking at a whiskey distillery where the operating cycle, aging the product, takes 5 years.
A very tasty operating cycle.
Exactly. Are you telling me a receivable expected to be paid in 3 years is classified as a current asset?
Yes. That is the exact statutory requirement. And honestly, it is the source of endless debate among practitioners.
I can imagine.
The query sent to GAAP advisors asked a very blunt question. Doesn't classifying an asset that takes 3 years to turn into cash as current completely contradict the overarching framework of Ind AS?
Because the practitioner was essentially arguing that the term current implies imminent liquidity, right?
Yes, exactly. They're thinking current means right now, or at least very soon.
And I totally understand the practitioner's skepticism. Think about how algorithmic trading models or quantitative analysts screen companies.
Oh, they just scrape the data.
Yeah, they pull the current assets figure and divide it by current liabilities to calculate the current ratio. It is a fundamental liquidity test.
The classic quick check.
Right. If I see a massive number under current assets, my immediate assumption is that this company has a highly liquid cushion to handle short-term shocks.
They can pay their bills tomorrow.
Exactly. If I am looking at that whiskey distillery where the product must age in a barrel for 7 years, and they classify a receivable tied to that aged inventory as current, my liquidity analysis is fundamentally broken.
Because the cash isn't coming tomorrow.
Right. I'm assuming cash is arriving in months, but the reality is measured in half decades.
Well, let's pause on that assumption for a second, because that is where the primary user of the financial statement has to recalibrate their understanding of what the balance sheet actually represents.
Okay, recalibrate how?
And AS is not attempting to create a universal timeline for all businesses. The framework's objective is to provide a true and fair view of a specific entity's economic reality.
So it's relative to the business itself.
Exactly. If we force your hypothetical whiskey distillery to classify its core working capital as non-current simply because it breaches an arbitrary 12-month threshold, we distort the reality of their business model.
Oh, I see. Because if we push all of that into the non-current bucket, their current assets drop to near zero.
And making them look insolvent.
Which is precisely the opposite of a true and fair view.
Right. The standardizes the concept of working capital, not the duration.
That's a great way to put it.
An operating cycle is the heartbeat of the enterprise. Anything circulating within that specific bloodstream, the raw materials, the work in progress, the eventual receivables, and the associated payables, it's current for that specific entity.
So CA Manish C Iyer provides an unequivocal response in the newsletter.
He does. He says classifying these items as current because they are part of the operating cycle is not a contradiction. It is the intended, faithful application of the framework.
But, if the standard is that explicit, if the underlying philosophy of the operating cycle is so deeply embedded in the framework, why is it causing enough confusion on the ground to warrant this kind of authoritative clarification?
Well, the confusion does not stem from a misunderstanding of the business cycle. It actually stems from a profound failure in regulatory communication.
Oh, really?
Yeah. The newsletter highlights that the ambiguity was actually introduced by the very bodies meant to clarify the rules.
Kidding.
Nope. And it all hinges on the interpretation of a single preposition within the text of Ind AS 1.
Okay, let's get into the grammar of accounting.
It's surprisingly dramatic.
So the text of paragraph 66A and 69A uses the word in. It states that an entity shall classify an asset as current when it expects to realize the asset or intends to sell or consume it in its normal operating cycle.
Right, in.
But paragraph 66C and 59C use the word within when discussing realization within 12 months.
And those two words, in and within, they carry vastly different legal and operational burdens.
I can see that.
Huh?
Being in a cycle refers to participation and integration.
Yes.
Being realized within a cycle refers to a strict temporal boundary.
Like a ticking clock.
So the newsletter exposes that the Institute of Chartered Accountants of India, the ICAI, which issues guidance notes to practitioners, they publish material that replace the word in with within when describing the operating cycle test.
Yes. They altered the actual text of the standard in their guidance and then interpreted the classification rules based on that altered vocabulary.
That is insane. This is like the difference between being in a building versus arriving within 10 minutes.
That's a perfect analogy.
If I am in the operating cycle, I belong to its ecosystem, regardless of the timeline. If I have to be realized within it, I am bound by a ticking clock. It changes the entire meaning.
It absolutely does. And the implications of that are staggering if you understand how audits are actually conducted on the ground.
Because auditors follow the guidance, right?
Exactly. An audit partner does not always have the luxury of debating the philosophical intent of the International Financial Reporting Standards.
They're just trying to get the file closed.
Right. They often rely on the technical guidance notes issued by their local institute to operationalize the audit. So when the ICI swapped in for within, they inadvertently weaponized the operating cycle.
Because within creates that ticking clock.
Yeah.
If I am a participant in a 5-year shipbuilding cycle, my trade receivables are current. The moment you say the asset must be realized within the cycle, you change the test from one of participation to one of duration.
And that leads to a cascading failure in presentation. Imagine a scenario where the operating cycle is clearly defined as 15 months.
Okay, 15 months.
The company has a trade receivable that is expected to be settled in 18 months due to a specific credit arrangement with the major client.
So longer than the cycle.
Right. But that receivable is inherently part of the working capital, right? It was generated by the core operations. Under the actual standard, paragraph 66A, it is in the operating cycle, and therefore it is a current asset.
But under the flawed guidance, using the word within, the auditor looks at the 18-month settlement date, compares it to the 15-month cycle, and says, well, it falls outside the boundary. We must reclassify it as non-current.
Which artificially strips working capital from the current section of the balance sheet.
Making them look less liquid than they actually are.
Exactly. This is why CA Manish C Iyer points this out with such severity in the newsletter. He notes his surprise at how authoritative guidance could make such a fundamental textual alteration.
It's a massive oversight.
Huge. He concludes that all paragraphs in Ind AS must be mandatorily followed unless specified otherwise. A guidance note cannot override the foundational text of the standard.
It really underscores the fragility of financial reporting. We treat these documents as monuments of objective truth, but they are highly susceptible to bureaucratic drift.
Just one word.
A single misplaced preposition at the regulatory level forces thousands of companies to misrepresent their liquidity, and by extension, forces analysts to build valuation models on flawed data.
That concept of precision, the absolute necessity of holding the numbers to the exact mechanics of the framework, that brings us to the forensic core of this newsletter.
Oh, this is the good stuff.
Yeah, while the first section dealt with the theoretical application of a word, the second section takes us into an actual published financial statement where the mechanics of the accounting completely break down.
Time to play detective.
Exactly. We are going to look at a company that attempted to project an image of perfect financial health, but left a glaring mathematical paradox in their disclosures.
Okay, let's lay out the framework of this anomaly. The newsletter systematically breaks down 3 different areas of the company's financial report: the operating cash flows, the investing cash flows, and the balance sheet notes.
So we have 3 pieces of evidence.
Right. I want to walk through the numbers exactly as they were presented to the public so everyone can follow the math.
Perfect. Let's start with Exhibit A, the statement of cash flows. Specifically, the adjustments made to reconcile net profit to net cash provided by operating activities.
Right, because net profit includes non-cash items and items that belong in other categories. So the company reported a deduction for interest income to arrive at their operating cash flow.
Because interest income is generally an investing activity, so you back it out of operations.
Got it. For the current year, that deduction was exactly 8,605,710 rupees. And for the comparative prior year, It was 3,746,261 rupees.
So they are essentially saying, we earned this interest income, it is included in our profit, but because it is an investing activity, we are removing it from the operating section.
That is standard procedure, right?
Completely standard.
Yeah.
The critical number here is the current year's recognized interest income, 8,605,710 rupees.
Okay, so we've got Exhibit A. Now we move to Exhibit B, the investing activity section of that same cash flow statement.
This is where they have to show the actual cash they received from their investments.
Right. They report a line item titled Interest Received, and the amount is exactly 8,605,710 rupees for the current year.
And 3,746,261 rupees for the comparative year.
Okay, so their income exactly matches their cash received. On the surface, that looks perfectly neat. I bill you $100, you pay me $100 in cash. Where is the crime?
Well, this is where a casual reader of the financial statement stops reading and assumes everything is fine.
I mean, I probably would have.
Most people do. The income recognized in the profit and loss statement matches the cash received in the bank down to the final rupee. It presents a narrative of perfect efficiency.
Every rupee of interest billed was successfully collected in cash during the year.
But financial analysis requires cross-referencing. You cannot trust a flow without checking the reservoir.
Ooh, I like that.
So the newsletter directs our attention to Exhibit C, the notes forming part of the balance sheet, specifically Note 15, which details other financial assets.
And what's in there?
Within this aggregated note, there is a line item for interest receivable.
Okay, so the interest receivable balance is the reservoir of uncollected money. This is interest the company has legally earned, but the cash has not yet arrived.
Exactly, it's an IOU.
Right. So in the comparative prior year, that balance was roughly 4.1 million rupees. But in the current year, the interest receivable balance grew to roughly 5.8 million rupees.
Now, walk through the mechanical reality of that balance increasing. What has to happen in the accounting ledger for a receivable balance to grow year over year?
Well, if the amount of uncollected interest went up by roughly 1.7 million rupees, it means the company accrued new interest income during the year that they did not collect in cash.
Bingo.
The additions to the receivable bucket outpaced the cash pulled out of it.
And that completely destroys the narrative presented in the cash flow statement.
Wait, yeah, it does.
Under the accrual basis of accounting, interest income recognized in the P&L represents everything you earned. Interest received in the cash flow represents what you actually collected.
So if your receivable balance increases, it is a mathematical certainty that your recognized income is higher than your cash collected. They cannot be the same number. It is physically impossible.
Nope.
If I earn $10, but my uncollected debt goes up by $2, I only collected $8 in cash. But this company told investors we earned $8.6 million and we collected $8.6 million in cash, while simultaneously admitting deep in the footnotes that their uncollected pile grew by $1.7 million.
It's a total paradox. The newsletter states the conclusion bluntly. In the absence of further information, it appears that either the interest received reported under cash flows from investing activities is improper, or the interest income and accrued interest reported in the P&L and balance sheet are improper.
The statements are at war with each other.
They cannot coexist. The internal logic has collapsed.
Wow. Why does this happen? We know it violates Ind AS 7, right?
Yeah.
Statement of cash flows.
Specifically paragraph 43, yes, which explicitly mandates that investing and financing transactions that do not require the use of cash or cash equivalents shall be excluded from a statement of cash flows.
So essentially, a cash flow statement should be treated like a physical wallet.
A perfect analogy.
If you didn't physically put a dollar bill into the wallet, you can't say it's in there, even if someone owes it to you. By putting non-cash items on a cash flow statement, they are projecting an illusion of liquidity.
You absolutely cannot put paper accruals into a cash statement. By reporting the exact same amount for interest income and interest received despite a massive movement in receivables, the company clearly jammed non-cash investing transactions into their cash flow statement.
But what is the corporate motive here? Why would a CFO or a reporting team risk such a glaring contradiction? Why not just report the lower cash figure?
To understand the motive, you have to look at how capital markets evaluate corporate performance. The statement of cash flows is heavily scrutinized by institutional investors, credit rating agencies, and algorithmic models.
It's the ultimate reality check against the income statement, because profit is an opinion, but cash is a fact.
Exactly. So there is immense pressure to show strong cash conversion. Analysts track a metric called the cash conversion ratio. How efficiently does a company turn its accounting profit into actual liquidity?
Right.
Furthermore, investing cash flows are closely watched to gauge the actual yield on a company's financial assets. If a company has a massive portfolio of loans or investments, stakeholders want to see the hard cash generated by those assets, not just the accrued paper returns.
Oh, I see. If they reported the reality that their interest income was $8.6 million, but their actual cash received was significantly lower, it would trigger questions about the quality of those assets.
Huge red flag.
Analysts would ask, why aren't your debtors paying you? Is that interest ever actually going to turn into cash, or is it going to become a bad debt?
Precisely. By artificially inflating the interest received line in the cash flow statement to perfectly match the income, they neutralize those questions.
They present an illusion of perfect liquidity and high-quality asset performance.
While masking the deterioration in cash collection, the user of the financial statement looks at the investing cash flows and assumes the company is flush with liquidity from its investments, entirely unaware that a significant portion of that cash is just an IOU sitting in a growing receivable account.
It is essentially window dressing the liquidity profile. But you know what fascinates me about the newsletter's analysis?
What's that?
The company didn't just fabricate the cash flow number and hope nobody noticed. They actively employed structural tactics to make the discrepancy harder to find.
Oh, they definitely tried to cover their tracks.
The math error is glaring once you see it, but they tried to bury the evidence using the architecture of the balance sheet notes.
And this brings us to a critical enforcement area within the framework, in AS1, paragraph 7, which deals with the concept of obscuring information.
Obscuring information. That sounds a bit more sinister than just making a mistake.
It is. Historically, accounting fraud was viewed purely through the lens of omission or direct misstatement. Leaving a liability off the books or inventing a fake asset.
Like the classic Enron-era tactics of hiding debt in off-balance sheet special-purpose entities.
Exactly. But as reporting frameworks evolved, standard setters realized that companies could technically comply with disclosure requirements while still actively deceiving the reader.
So they give you the information, but they make it impossible to understand.
Right. They do this by weaponizing complexity. Paragraph 7 formally defines obscuring information as communicating it in a way that would have a similar effect on the primary users as omitting or misstating it.
So hiding the truth in a labyrinth of data is treated with the same severity as lying.
Yes. The standard actually provides a list of examples of how companies achieve this, and reading through them feels like looking at a corporate playbook for plausible deniability.
Let's examine those methods because they are vital tools for any financial detective listening right now.
Let's do it.
So the first method is using language that is vague or unclear. This is the classic strategy of burying a significant risk in paragraphs of dense, impenetrable legal jargon so that the reader simply gives up trying to understand the economic substance of the transaction.
We've all seen those footnotes that just make your eyes glaze over.
Absolutely. The second method is scattering information throughout the financial statements. You put the asset valuation on page 30, the associated risk factors on page 112, and the actual cash flow impact deep in a footnote on page 180.
The user is forced to play a massive game of connect the dots.
And most won't bother.
Right. The third and fourth methods deal with aggregation, inappropriately aggregating dissimilar items, transactions, or events. Or, conversely, inappropriately disaggregating similar items to fragment the picture.
Which is exactly what this company did. Right.
Spot on. And the final method is hiding material information behind a wall of immaterial information. Overwhelming the user with so much irrelevant data that the critical warning signs are lost in the noise.
The newsletter specifically flags the company in our case study for violating the rule against inappropriate aggregation of dissimilar items.
Yes. We need to look closely at Note 15, where the company grouped its assets.
Okay, what did they do?
They created a catch-all category titled Other Financial Assets. Within this single note, they lumped together the interest receivable balance, which we know contains the mathematical discrepancy, with completely unrelated items like receivables from parties, other receivables, and potentially standard trade balances.
Okay, I try to conceptualize this using a personal finance analogy.
I love your analogies. Let's hear it.
Imagine you are presenting your financial health to a mortgage lender. You take your high-interest, incredibly volatile credit card debt, and you combine it in a single spreadsheet row with your fixed, low-cost monthly utility bills and your $10 streaming subscriptions.
Oh, that's brilliant.
You label that entire blended row monthly hobbies and expenses.
Nice and harmless.
Right. You haven't omitted the credit card debt. The dollar amount is technically included in the total. but by inappropriately aggregating it with entirely dissimilar, low-risk items. You have completely obscured the specific nature and severity of your financial risk.
That analogy perfectly captures the structural damage caused by improper aggregation. By blending the accrued interest with generic receivables, the company attempts to dilute the visibility of that growing uncollected balance.
We're hoping the analyst just glosses over it.
Exactly. They are hoping the analyst looks at the total bucket of other financial assets, sees a marginal overall increase, and moves on without interrogating the specific components.
But the consequences of this aggregation go far beyond just hiding a bad number, don't they?
Oh, way beyond.
The newsletter reveals that this attempt at camouflage actually triggers a violation of one of the most complex standards in the entire framework, Ind AS 109, which governs financial instruments.
Yeah, this is where the cascading nature of reporting failures becomes truly apparent.
Let's talk about Ind AS 109.
Ind AS 109 is a highly rigorous standard that was heavily influenced by the fallout of the 2008 financial crisis. Its primary goal is to ensure that financial assets and liabilities are measured and presented in a way that reflects their true risk and economic reality over time.
And a key component of this is the concept of amortized cost.
Yeah.
Right.
Yes. Let's spend some time on the mechanics of amortized cost, because it is central to why the company's reporting collapsed.
Okay, break it down for us.
Amortized cost is not just a static number, it is a dynamic valuation method. When a company holds a financial asset, like a loan or a long-term receivable, the carrying amount on the balance sheet is not simply the principal amount owed.
So you don't just put down the face value of the loan.
No. It must be calculated using the effective interest method. This involves projecting all the estimated future cash flows, both principal and interest, over the expected life of the instrument, and then discounting them back to their present value using the asset's original effective interest rate.
So it incorporates the time value of money and the specific cash flow timeline of that exact asset.
Exactly. Crucially, it also incorporates risk. Under Ind AS 109, you must constantly assess these assets for impairment using an expected credit loss model.
Right.
If the timing of the cash flows changes, for instance, if a debtor delays paying their interest, the present value of that asset decreases. The amortized cost drops.
And this requires immense precision. You have to know the exact terms, the exact interest rate, and the exact risk profile of the specific asset you are measuring.
Which brings us back to the company's decision to aggregate dissimilar items in Note 15.
Uh-oh.
Yeah. The newsletter points out a devastating consequence of this grouping. An accrued interest receivable inherently belongs to the specific financial asset that generated it.
Because the interest is just the yield on that specific principal.
Yes. It shares the same risk profile, the same counterparty risk, and the same effective interest rate as the principal loan or investment. Therefore, to accurately present the amortized cost of that financial asset under Ind AS 109, the principal and the accrued interest must be evaluated together.
But the company severed that connection.
They severed it completely. They took the accrued interest, stripped it away from its parent asset, and dumped it into the generic other financial assets bucket alongside random receivables from different parties with entirely different risk profiles and different timelines.
They blended the risk pools.
Yes, and the moment you blend fundamentally different financial instruments into a single aggregated line item, the resulting number loses all mathematical integrity.
You can't untangle it.
You can no longer apply an effective interest rate to that blended bucket. You cannot accurately calculate an expected credit loss provision for a bucket that contains both a highly secure 30-day trade receivable and a highly risky 5-year accrued interest balance.
So the carrying amount of the combined line item no longer represents the true amortized cost required by the standard.
Exactly. By trying to clean up the presentation and obscure the cash flow discrepancy, they broke the valuation mechanics of their own balance sheet.
That's honestly wild. So what is the final word from GAAP advisors on this?
The author, CA Manish C. Iyer, delivers a very stark verdict based on this analysis. He concludes that due to this inappropriate presentation and aggregation, the company has failed to comply with the requirements of both Ind AS 109 and Ind AS 1.
Okay, it's bad.
But the final sentence is the most impactful. He says, quote, "The effect of such presentation is that none of the components of financial statements present a true and fair view."
Wait, none of them. That is a total invalidation of the document. He isn't saying there is an error on page 42. He's saying the entire architecture is compromised.
And that is the reality of interconnected financial frameworks. It is a house of cards.
Because one lie begets another.
Right. If your statement of cash flows is projecting an illusion of liquidity, violating Ind AS 7, and your balance sheet notes are inappropriately aggregated to hide that illusion, violating Ind AS 1, which in turn destroys the mathematical integrity of your amortized cost valuations, violating Ind AS 109.
The whole thing comes crashing down.
The primary user can no longer trust any metric derived from those statements. The fundamental purpose of the report, to provide a reliable basis for economic decision-making, is destroyed.
It is a phenomenal piece of forensic work by GAAP advisors, and it fundamentally changes how you look at a set of published accounts. When we step back and look at the entire journey of this deep dive, the overarching theme is the profound danger of taking corporate reporting at face value.
We really went on a journey today. We began by looking at how the entire perception of a company's working capital can be skewed by a regulatory body misusing the word within instead of in.
A single preposition redefined the boundary of the operating cycle, forcing perfectly healthy assets into non-current classifications and distorting liquidity ratios across the market.
And from there, we moved into the mechanics of deception. We saw how a company manipulated its ingesting cash flows to perfectly match its recognized income, creating a facade of flawless cash conversion.
But because double-entry accounting always leaves a footprint, the truth was sitting right there in the growing accrued interest balance in the footnotes. The math simply did not allow for both statements to be true.
Finally, we explored the structural length a company will go to in order to obscure that footprint.
By inappropriately aggregating that problematic interest balance with generic receivables.
Yeah, they attempted to hide the discrepancy in plain sight, only to inadvertently trigger a massive violation of the complex valuation rules under Ind AS 109.
This is exactly why an understanding of these frameworks is so critical. Whether you are an analyst building a discounted cash flow model, an auditor signing off on a statutory report, a credit officer evaluating loan covenants, or simply an investor trying to allocate capital, you cannot just plug the headline numbers into a spreadsheet and assume they represent reality.
You really can't.
You have to understand the rules governing those numbers. You have to verify the cash flows against the balance sheet movements. You must actively hunt for instances of inappropriate aggregation.
The framework provides the tools to uncover the truth, but only if the user is willing to cross-reference the data and interrogate the presentation. The numbers never exist in a vacuum. They are always the product of interpretation and structural decisions.
And that leads to a final, very provocative thought to close out our analysis today. The company we examined in this deep dive was caught because their execution was flawed.
Right, they messed up the math.
The math between their income statement, their cash flows, and their footnotes created an irreconcilable paradox that a sharp forensic eye could expose. They left the breadcrumbs. But consider the sophistication of the rules surrounding the obscuring of information under Ind AS 1.
Oh, it's chilling. The ability to use vague language or to scatter vital context across hundreds of pages or to technically comply with disclosure rules while burying the material risk beneath a mountain of immaterial data.
Exactly. It forces you to wonder, if this company was caught because of a clumsy mathematical error, how many highly sophisticated, perfectly balanced, and flawlessly audited financial statements are out there right now?
It's a scary thought.
Statements that contain no mathematical paradoxes, no direct misstatements, and no technical rule breaks, but are brilliantly engineered to legally obscure the true economic reality of the business right in front of our eyes.
A perfectly balanced ledger does not necessarily equate to a transparent reality. Sometimes the most dangerous risks are the ones fully disclosed, but entirely hidden.
It is a reality that should change the way every single one of us reads an annual report. Thank you for joining us on this exploration of the GAAP Advisors Task Weekly newsletter. Keep questioning the framework, keep cross-referencing the data, and we will see you on the next deep dive.